Welcome to XRP Pro Ledger, and today we need to address something directly before we get into the data, because in the last 96 hours, 175 million XRP has been removed from centralized exchange order books, quietly, methodically, and almost entirely outside of retail awareness. A leaked internal banking research note has surfaced in private institutional channels, and the number it produces is not a speculative price target, it is a structural liquidity requirement. To settle just 3% of high-value institutional cross-border daily volume on the XRPL without triggering catastrophic market slippage, XRP requires a minimum price floor of $4.45. At the same time, Standard Chartered has revised their institutional price target upward to $28, tied directly to the $4 to $8 billion in potential US ETF inflows and the approaching regulatory clarity. Stay with this analysis until the end, because the Clarity Act Section 6 Safe Harbor language, the provision that permanently exempts XRP from security classification under secondary market trading conditions, is the regulatory trap that is closing right now, while retail investors are still waiting for mainstream confirmation that will arrive far too late. Let us start with the psychological position that most retail holders are operating from right now, because the gap between what retail perceives and what institutional data confirms has never been wider in this market cycle. The price is consolidating, the chart is not producing dramatic moves, and the absence of dramatic price action is being interpreted by the majority of retail participants as an absence of meaningful activity. That interpretation is incorrect. Price consolidation in the presence of aggressive on-chain accumulation is not a signal of institutional indifference. It is the operational signature of institutional accumulation at scale. When large capital pools are building positions in a liquid market, the last thing they want is price volatility drawing attention to their activity. The flat price is not the market telling you nothing is happening. The flat price is the market telling you that the entities with the most capital are actively suppressing volatility to protect their accumulation window. The on-chain data from the last 24 hours confirms this accumulation framework with a level of precision that removes any ambiguity about what is happening beneath the surface. The number of whale wallets holding 10 million or more XRP has increased by 7 in a single 24-hour window during price consolidation, not during a price surge. This is the critical detail that separates informed analysis from surface-level chart reading. Whales do not accumulate during price surges. They accumulate during the consolidation periods that retail investors dismiss as dead time. 7 new wallets crossing the 10 million XRP threshold in 24 hours represents a combined minimum of 7 million tokens moving into long-term holding positions while retail attention is directed elsewhere. And this whale accumulation is occurring against a backdrop of 31.4 million XRP drained from exchanges in just the last 20 hours, flowing into unidentified Tier 1 institutional custody wallets with no corresponding sell-side pressure on the order book. The $4.45 structural floor calculation is the most important number to understand in this entire analysis, because it reframes the current price as something entirely different from what retail participants perceive it to be. A leaked internal banking research note circulating in closed private institutional channels presents the math directly to facilitate just 3% of the high-value institutional cross-border daily volume that is being routed through XRPL infrastructure, without generating the kind of market slippage that would make the settlement cost advantage over SWIFT disappear. XRP requires a minimum market price of $4.45, 3%, not 10%, not 30%, not full integration of the cross-border payment corridor. 3% of existing institutional volume at current transaction velocity demands $4.45 as the structural minimum. The current price is not the market's assessment of XRP's value. It is the price at which institutions are accumulating before the 3% threshold makes the current price structurally impossible to maintain. Standard Chartered's revised price target of $28 adds institutional credibility from an independent analytical direction that operates entirely outside of the crypto-native research ecosystem. Standard Chartered is one of the world's most systematically significant trade finance institutions. Their analysts do not produce price targets for digital assets based on community sentiment or social media momentum. Their $28 target is tied to two specific and verifiable inputs: the $4 to $8 billion in potential institutional inflows through US spot XRP ETF products, and the approaching US regulatory clarity event that Section 6 of the Clarity Act is delivering. When a trade finance institution of Standard Chartered scale commits a published price target to an asset class, the target represents the output of risk modeling that their own institutional clients and trading desks are using to make allocation decisions. That is not a retail price prediction. That is a balance sheet signal. The Clarity Act Section 6 Safe Harbor provision is the regulatory mechanism that is creating the front-running dynamic that this entire accumulation pattern is built around. The specific language confirmed in Section 6 establishes that digital commodities assets meeting defined liquidity and decentralization criteria are exempt from security classification as secondary market trading conditions. The legal significance of that language is absolute. The Howey test, which the SEC has used as its primary instrument for asserting jurisdiction over digital assets, cannot be applied to an asset that a congressional statute has explicitly exempted from its scope. The SEC does not surrender this jurisdiction voluntarily. It surrenders it when Congress removes the statutory basis for the claim. Section 6 removes that basis, and the institutions that have been operating under NDAs, waiting for precisely this regulatory certainty before converting quiet due diligence into public partnership announcements, are front-running the retail market right now before the mainstream financial press has processed what the language actually means. David Schwartz addressed the NDA environment directly in a recent public interaction, and his framing deserves careful attention. He dismissed what he called NDA conspiracy theories, the idea that NDAs represent institutions hiding something problematic, by explaining that NDAs are standard commercial privacy instruments in U.S. institutional finance. Banks and financial institutions do not announce partnerships before the legal, compliance, and technical integration frameworks are complete. The NDA is not the story. The NDA is the mechanism that allows the story to be built correctly before it becomes public. When NDAs convert into press releases, and Schwartz's framing strongly implies that conversion is being sequenced, the market that sees the announcement as news will be buying into positions that institutional capital has held for months. The quiet accumulation happening right now is the operational definition of that sequencing in progress. The supply compression data, viewed as a complete 96-hour picture, produces a market structure that has no functional precedent in XRP's trading history. 175 million XRP removed from centralized exchange order books in 4 days. 7 new whale wallets crossing the 10 million token threshold in 24 hours. US spot XRP ETFs now holding approximately 828 million XRP, 1.2% of the total circulating supply, after absorbing an additional $500 million in institutional purchases during the current consolidation phase. The combination of ETF absorption, whale wallet expansion, and direct custody transfers is compressing the available retail float at a velocity that the current price does not reflect. Institutional desks are modeling what they are calling a supply shock pivot at the $1.65 level, a price point at which exchange liquidity becomes thin enough that any meaningful buy-side demand produces exponential rather than linear repricing. The distance between current prices and that pivot level is narrowing with every custody transfer. The RLUSD infrastructure development running in parallel with the supply compression provides the system confirmation that the institutional thesis is being built on operational utility rather than speculative positioning. The 105% U.S. Treasury collateralization rule is generating a $4.80 million weekly interest surplus, capital that is being deployed into what Ripple is internally calling the Native XRPL Liquidity Incentive Program. This program pays institutional market makers directly to maintain narrow spreads on XRP trading pairs across the XRPL's decentralized exchange infrastructure. The practical consequence is mechanical. Tighter spreads mean lower transaction costs for institutional settlement, which improves the cost advantage over SWIFT, which increases the volume of institutional flow that routes through XRPL infrastructure, which increases the demand for XRP as the bridge asset in every transaction. The Treasury yield is funding its own demand expansion. That is a compounding financial mechanism, not a marketing program. The Smart Custody Vault launch on the XRPL today provides the final operational confirmation that institutional capital is not waiting for the Section 6 announcement to deploy into XRP infrastructure. A new KYC-verified institutional custody product attracted $12.50 million in XRP deposits from verified institutional participants in just 12 hours. The KYC verification requirement ensures that the depositing entities are institutional in nature, regulated financial entities with compliance obligations that preclude speculative retail stock positioning. $12.5 million from KYC-verified institutions entering a single XRPL custody product in half a trading day. That velocity of capital commitment is the data point that connects every element of today's analysis: the $4.45 structural floor, the Standard Chartered $28 target, the Section 6 safe harbor, the 175 million token supply vacuum, the 7 new whale wallets, and the $4.80 million weekly liquidity incentive program into a single coherent picture of an institutional front run that is operating at full velocity while retail attention remains elsewhere. If this analysis changed how you're thinking about XRP, hit like and subscribe. I drop deep dive breakdowns like this twice a day to keep you ahead of the market.